Hi everyone, my name's Nathan. I'm head of research here at Search Party Property. So it's just a quick video to provide you with a bit of an overview concerning our use of data within our three-step investment research process. So I'll begin by briefly explaining each of those steps and then take you through a couple of simple examples to demonstrate how it all works. So first and foremost in our process is our initial step focusing on market foundations and risk. So the question we're trying to answer is essentially, is this market even worth considering further, or is it just too risky for us to be confident in? We do that firstly by ensuring that we actually have high confidence in the data available to us through sufficient sales volumes and market activity. Because to take an extreme example, a suburb might look great, but there've only been 3 sales in the past year. We can't really be confident of discerning a meaningful trend within that data. And then on top of that, we also control for affordability and socioeconomic levels. And this is a really crucial one because we know that a majority of properties in Australia are owner occupied. So the overall growth of the market is going to be driven in large part by how affordable those houses are. We also know that socioeconomic levels are an excellent predictor of price growth. Then a few other key things at this level are industry dependence. We look into the level of economic diversity within a market, as well as broader economic potential and investment, as well as, of course, environmental risks such as flooding, etc. Then secondly is growth momentum. So, okay, we're happy with the risk profile and expected stability for this market, but will it actually grow? Then secondly is growth momentum. So, okay, we're happy with the risk profile and the expected stability for the market, but will it actually grow and by how much? The key factor at this stage is actually supply side variables, since supply is a lot more predictable and baked in than demand, which can fluctuate a lot more wildly as the market reacts to big price changes or news. So often by the time you start seeing those big shifts in demand through things like days on market tightening, you've likely already missed out on a decent spike in price growth. So by monitoring certain key price metrics like trends in stock on market, inventory, and building approvals, which of course takes a while to actually materialize as a new house on the market, then we can identify those markets that are best positioned for growth before it actually happens. Then lastly is cycle positioning. So we know a market is low risk. We know that it seems to have excellent potential for growth. The final question to answer is, when should we actually enter? And this will vary a little bit depending on your own goals, but by understanding where a market is in its growth cycle, we can determine whether we're getting in early ahead of the growth, or if we're getting in around about the peak of growth. We'd rather see a more immediate return on investment. And a key assumption here is something called mean reversion. Since we know that growth tends to average out over the long run, we can quite clearly see where growth is below the average, or where there's about to be a major shift in momentum in price, or conversely, where really hot markets are about to lose some steam. And another key factor here is an assessment of how active other investors are in the market. So through things like price discounting levels or short-term changes in vacancy rates, we can see where investors are starting to become active and converting properties into more rental stock on the market. So to give you some idea of how this process works in action, I'll just begin to apply some filters onto this suburb mapping tool, focusing initially on Melbourne and some of the surrounding areas, just to show you how quickly we can start to drill down towards a few key investment locations. So having applied a price cap of $600,000 and some basic thresholds regarding risk, stability, and supply side tightening, we arrived at a much smaller shortlist of potential options, as you can see, compared to the previous map we were looking at. Right now, the color coding here is based on yield. So right away, you can see that for most of the options in this cluster to the northwest of Melbourne, yields will tend to be a bit lower than they are for some of these options around Geelong, for example. So just as an example, Melton South with a yield of 3.93% versus a suburb like St Albans Park with a yield of about 4.23%. Even though some of these areas may have a fairly comparable profile in terms of risk or some of those supply side metrics, we may still prefer one over the other for something like a more of a cash flow focus, for example. Then if we change the color coding quickly to price change in the past year, you can see that St Albans Park has actually fallen by about 7.5% over the past year, while Melton South which we were just looking at, has actually risen marginally by almost 4%. Or if we up our price point to under $750,000, we of course end up with a much wider range of options that still fall within our search criteria for risk and growth potential. And if we were to compare this to a different region, for example, Townsville, we see that again, a lot of the areas here that our filters have picked up have performed very differently over the past year to those in Melbourne, which really demonstrates the role of understanding cycle positioning. So again, still the color coding is the same here based on price change in the past year. For example, you can see that Birdle with a typical price of 695,000 has grown by actually 32.64% in the past year, meaning you're more likely to see a lot more rapid capital growth immediately in an area like this than you would in Melbourne. While the fundamentals for a lot of those areas in Melbourne would still seem to indicate their potential as a long-term stable growth option at a much lower entry point for a capital city. So then if we were to look more closely at a market like Birdle, we see, of course, that enormous spike in price growth over the past year. We can also see that net growth over the past year at 32% accounts for actually about a quarter of total growth over the past decade, which just goes to show how far this market has been outperforming its long-term average more recently. And then accordingly, that's reflected in the growth cycle analysis here. And then that accordingly is reflected in the, which indicates an expectation of softening growth across the next couple of years, as you would expect as growth sort of returns to its long-term average for the market. We see also that ERSAD, a measure of socioeconomic level, is really strong at 7, which is a score out of 10. And our affordability index is really positive at under 30 years to own, which suggests that prices are still quite comfortably affordable for the local residents. And then looking at some supply factors, we can also see that ERSAD here, which is a measure of socioeconomic level, is really strong at 7, which is a score out of 10. And our affordability index is really positive at just under 30 years to own, which suggests that prices are still quite comfortably affordable for the area's local residents. And then looking at some of these supply factors, you can see that stock on market, inventory, and building approvals are all in a long-term decline, but have ticked up a little bit lately, while this long-term trend for vacancy rates clearly seems to point to strong investor activity driving that incredible growth we saw in the past year. So then looking at some supply factors, we can see that stock on market, inventory, and building approvals are all in a long-term decline, but they have ticked up a little bit lately. While also this long-term trend for vacancy rates clearly seems to point to strong investor activity driving that incredible growth in the past year. So that's a very simple example of how we can rapidly filter and assess markets using our research framework. Of course, there's much more depth we go into beyond these example metrics depending on your own goals, but the objective is always the same, just to eliminate risk and to give you a tactical advantage in the market. Thanks for watching.